Hello, everybody. This is Mike Preston at New Harbor Financial with a weekly update. It is Thursday, October 12th, and we just want to come on here every week and let you know what we're seeing, what we're doing, try to make some sense out of the madness in the markets. And, this week I want to talk a little bit about interest rates and bonds again. This has been an absolute hot topic the last couple of weeks, and I'd like to share some charts and just talk to you about what we're seeing and what we're hearing. There's been an absolute capitulation in the last couple of weeks, particularly last week in terms of bonds. I'm going to share up a chart here, just take a look at it together. So this chart is TLT. This is an ETF that holds long-term U.S. government bonds. So let's go to a monthly chart first. So what happened during quantitative easing is that bonds were bought by the Federal Reserve, and by buying bonds, they add cash to the economy and create liquidity, so-called quantitative easing. Well, this caused a bubble in everything. All financial assets, the prices went up over the last 10 plus years to levels that are really not sustainable. I'll talk about that in a minute, but it really caused a blow off top in bonds. And when prices of bonds go up, interest rates go down. And during these years, it was actually difficult to get any interest at all. Most of the time, you were getting 0% in a savings account. And even for a short period of time, short-term Treasury bills went into negative territory, meaning you got back less than you put in. That's how crazy things got. And then, of course, we hit a high here, and the market lost, quite a bit over the next year or two. But it wasn't until last March of 2022, when the Fed started raising short-term rates, that the bond market really cratered. And so, we looked at this and still look at this as an opportunity. If this market crashes this much, there's a high likelihood that it's overshooting to the bottom. And so we started entering, up here with hedges up in this area, 120-ish. And little do we know that there was more capitulation to come. One interesting thing to note is that the entire total return of the long-term U.S. government bond market has been erased as of last week. All the gains have been given back, including interest payments. So the total return has been erased since the financial crisis. This drop here is a mammoth drop. This panic in this market is something that I've only seen in things like tech stocks back in 2000 to 2002, and in some sectors of the broad market back in 2008, 2009. But this is just a stunning bear market, and it's surprising because not a lot of people are talking about it. It's true that interest rates were abnormally low back a few years ago, and that bonds were abnormally high because of central bank intervention. But this disaster is a huge thing. The bond market is much bigger than the stock market, and so far the stock market doesn't care. Shocking to us, actually, that the stock market is near its highs. Housing prices are near their highs. They're hardly budging, and yet we've seen an absolute meltdown in bonds. And we can tell by the comments that we're getting and the questions that we're getting. Let's take a look at a daily chart, that we're really close to a low, and we may have seen the low in bonds and a high in interest rates for the short term. You can almost feel it and hear it. The capitulation last week, we had things like Jamie Dimon coming out and saying, well, we might see 7% on T-bills short term, that kind of thing. And there's many, many questions from people about bonds. This is when you want to be buying, or at least not selling. And we were already in the position, and unfortunately a little bit early, but our hedges let us hold on to this position. We have put options at 92 that expire in November on half the position. We've been selling calls on the other half, bringing in income and hedging. And so we saw this, what I think is a swing low last week, and we've already bounced from 84 to almost 89 on TLT. That's a pretty big move. That's a 6 or 7% move in just a couple days. We'll see what happens over the next few days. But for people that are in high quality long-term bonds, I wouldn't be selling them here. Be wary of your position size. I don't think I'd go more than 20% maximum in long-term bonds in any portfolio. The risk is just too great. If we see another rollover and another capitulation, you don't want to be holding on to a big position size. But we're at about 7.5% max in our model right now, when you take into account our hedges, because we've got a maximum position of about 15%, and half of it is in the money on puts. So we're only about 7.5% in. So be mindful of your position size, but there's an opportunity here, I think. Now, for stocks, I can't say the same. Stocks have just not gotten the memo yet. Taking a look at the S&P on a daily chart, here is this well-defined head and shoulders top, left shoulder right here, head, and two right shoulders. We broke through, closed below this neckline. We touched the 200-day moving average, and then the war in Israel broke out, and it's pretty uncanny, but the market's been up every single day since that happened. That terrible thing happened last weekend. And of course, it's ongoing over there. So as in terms of global conflict, it's very sad, and we're distressed by what's going on, but it doesn't really affect the market in the near term, or at least we don't take that into consideration when we're making decisions about investments. What we're really looking at is price action. Right now, we have a pretty solid bounce off of this 200-day moving average. We're looking very closely at our shorter term indicators, our indicators of risk, things like breadth and bullish percent. We look at bullish percent of various large indexes or indices, and they're all on defense. It's possible we get another blow off top here, but so far our main guides are telling us that this is just yet another bear market bounce back up to the 50-day moving average. We'll look very closely at what happens. Taking a look at the monthly chart, it's just been an absolute blow off top from the COVID low. This is what $7 trillion of free money thrown into the system does. Last year's pullback was very contained, and so far it's been straight back up. So we'll see what happens. We'll go back here to the other chart, look at a weekly chart. We have had this big consolidation, and so far this looks like it might still be a handle in a cup and handle, but honestly, I do believe we accelerate to the downside. We have an elevator drop to about 4,100 on the S&P, and then it could be much lower into the low threes down to about 3,200. You could see a mini crash if this recent low fails. So we'll see. But the big picture really is that stocks are extremely overvalued. I'm going to share another chart just to explain what we're seeing. And this is a chart by John Hussman, somebody that we admire very much. This chart goes back over 100 years. We've shown this a few times, but I think it tells the story better than just about any other chart out there. This blue line is the S&P 500 going back to 1928. So this goes back almost 100 years. And then you can take a look at, you can model out what level would be consistent with 10% returns or 5% returns. John Hussman's model is very good. He looks at different measures of valuation that are highly statistically correlated with future returns. Things like non-financial market capitalization divided by gross value added, or market cap to GDP, or even Shiller price earnings ratios that are adjusted for profit margins. Well, you can see that if you were to expect a 5% risk premium over 10-year treasury bonds, at present, that would be around a 9 or about a 10% expected return. Let's call it 10%. Based on this model, you'd have to be down at around 1,800 on the S&P. And that's a drop of basically 2/3 from the S&P high on January 4th, 2022. And the big picture to me is that sometime in the 90s, the S&P departed from what would be a more normalized place. And that would be this green line here. This is where you'd expect 10% nominal returns. That doesn't, nominal returns don't take into account interest rates. It just takes a look at the actual price increase of the S&P. We basically took off from there and never looked back, except for 1 month in March of 2009, where we kissed that line and then went vertical. So it's been a permanently high plateau for going on 30 years now. There's no other place in the chart really that it's been overvalued to that extent. There has been a period of time where it's been undervalued. Well, the argument all of these years was that there is no alternative. Interest rates are zero. You have to buy stocks. You have to buy stocks. Well, interest rates are now 5.5%. Mortgages are 7.75. What's the excuse now? You know, this market has found excuse after excuse to not correct. And I understand the arguments about the wall of worry and things like that. But I can tell you that in the 90s, the Fed just got actively involved. Alan Greenspan encouraged us to use our homes as ATM machines. You know, then that actually exacerbated the tech bubble. The tech bubble corrected, and Bernanke and Greenspan reinflated that bubble and caused the housing crisis with zero interest rates and subprime mortgages. That crashed, and that only crashed back to normal valuations. We could have fallen another 50% easily from the low in 2009, but that was rescued because of the removal of mark-to-market accounting rules, FASB 157. And then, of course, it was straight up since then. We've had multiple attempts to try to correct. Each one has been saved by ever more liquidity, ever more Fed magic. We don't think that's going to go on very much longer. It has been frustratingly long. I will tell you that. A couple other things that I'd like to say, and then perhaps just wrap up. Oil prices. Oil prices came down about $10 in the last couple of weeks very swiftly. That's made some energy stocks look a little more attractive. We look every week at sectors, and both fundamentally and technically, we talk about what sectors look good. Fundamentally, we love the energy story, natural gas, oil, even nuclear, and we're looking closely at it. And oil has come off about $10 pretty quickly. So some of the names are getting a little bit more attractive. We'd like to see a deeper pullback. Another 10% or so would be ideal. And we would look at things like, or ETFs like XLE, the big refiners, or XES, the oil service companies. Lastly, I feel like I should talk about gold and the dollar. The dollar has been really, really strong. I'm going to pull up a chart of that too. I'll just use an ETF as a proxy because it's pretty easy. So here is UUP. Actually, let's see. This is the bullish dollar, UUP. So taking a look at a daily chart, it's been straight up for 3 months. On a weekly chart, you can see just how strong this has been. We're starting to close in on the old high. So the dollar's been really strong. That's a headwind for all commodities, actually, but in particular gold and silver. But gold has actually been hanging in there pretty well. A couple of weeks ago, there was this disappointing drop. I'm using GLD here just for illustration purposes. But if you really step back and take a look at gold on a monthly chart, I know I've said this many times, but it's pretty much the best long-term chart I can find anywhere in terms of its structure. This giant cup consolidation with this long drawn out base, flat base, or handle, maybe you'd call it, with 3 tops, 1, 2, 3, a triple top, often looked at as a bearish indicator. I don't believe is going to be a bearish indicator. I believe we're going to break out of this triple top and move up towards 2,500 on gold. But the dollar's been a headwind. But the fact that we've been hanging in here anyway, in light of the dollar strength, is pretty positive. Silver also looks very positive. So to wrap up, you know, we're looking at everything. We're making some adjustments to hedges. We adjusted the hedge on bonds a couple of weeks ago, TLT. We continue to hold a lot of cash, a little over 50% Treasury bills, getting paid over 5% on Treasury bills while we wait for better opportunities. But it's been frustratingly slow. The market has been frustratingly slow to respond. It's almost like an illusion, actually. It's almost, and I think a lot of it is an illusion. We have this permanently high plateau that has to stay there forever, or otherwise a lot of bad things happen. But that's what the Fed did. That's the situation that they put us in. And I know it takes a lot of patience, and it's hard to not be involved when it seems like others are making money. But remember, the S&P is if you look at the S&P 500, it's up about 11% or so year to date. But if you take out the 7 stocks, the 7 FANG stocks, and you look at the S&P 493, the S&P is absolutely flat on the year. If you take a look at the Russell 2000, those are the Mid-cap, the medium-sized companies, it's flat on the year. It's literally only 7 stocks that are driving this market. It's a very thin, very, very thin market. It's yet another sign that hasn't mattered, but it's a thin market with just a few stocks leading it. When they falter, and they will, I don't know when, but they will, then the entire market is at risk of a big downturn. So there's a lot at stake here, because it's really the Fed's credibility that's at stake. They've put everything they have into holding this thing up. There really isn't any plan B, as far as I can see. So I think central banks are saying, we hope this works. We hope we grow out of the problem. But I don't see how that's gonna happen. I don't see how GDP is going to have an explosive growth from here with corporate profit margins near all-time extremes. How are they going to expand from here? There's a lot, and the cost of materials are going up, and there's not a lot of room for an increase in labor, and the labor share of the pie. There's more demand for labor to get more of the corporate profit pie. So there's a lot of different competing forces that I think are going to make it very difficult to grow out of this problem. So here we are. We will do our best to continue to navigate it. And until next week, I thank you very much for watching. Thanks.